Introduction to Public Sector Accounting and Finance. Contents: 1. Purpose. 2. Introduction. 3. Objectives of Public Sector Accounting. 4. Users of Public Sector Accounting Information. 5. The Constitutional and Regulatory Framework of Public Sector Accounting. 6. Concepts and principles applicable to Public Sector Accounting and Finance. 7. Basis of Public Sector Accounting. 8. Comparison between government accounting and private sector accounting. 9. Chapter review. 10. Worked examples. Introduction to Public Sector Accounting and Finance. 1. Purpose. After studying this chapter, readers should be able to A. Enumerate the objectives of public sector accounting. B. Identify the various users of public sector accounting information. C. Demonstrate a good grasp of the constitutional and regulatory framework, as well as the concepts, principles, and basis of public sector accounting. 1. Introduction. The simplest definition of public sector is all organizations which are not privately owned and operated, but which are established, run, and financed by government on behalf of the public. This definition conveys the idea that the public sector consists of organizations where control lies in the hands of the public, as opposed to private owners, and whose objective involve the provision of services where profit-making is not a primary objective. Performance measurement in the public sector is hindered by the lack of profit motive, multiple objectives, and presence of intangible services whose benefits are difficult to quantify. Accounting generally is a scientific study in which records of expenditure and income of a company, individuals, or government are kept coupled with other useful information for planning, decision-making, and control. Government accounting, on the other hand, is composite activities of analyzing, recording, summarizing, reporting, and interpreting the financial transactions of government ministries, departments, and agencies. It is clear from this description that the government, like any business organization, should give an account of its activities to the various stakeholders or shareholders. R. A. Adams, 2004, in his book, Public Sector Accounting and Finance, Public Accounting and Finance Made Simple, defines public sector accounting as a process of recording, communicating, summarizing, analyzing, and interpreting government financial statements and statistics in aggregate and details. This concerned with the receipts, custody, and disbursement and rendering of stewardship on public funds entrusted. The above definition shares some features with the universally acceptable definition of financial accounting. Accounting is universal, whether in government, private, or public limited companies. The essential requirement is to record all historical costs and income, which when processed further become useful information necessary for current appraisal, future decision-making, and performance control. Basically, public finance is the study of the role of the government in the economy. It is the definitive branch of economics which assesses the government revenue and government expenditure of the public authorities and the adjustment of one or the other to achieve desirable efforts and avoid undesirable ones. 2. Objectives of public sector accounting. The main purposes of public sector accounting are: A. Ascertaining the legitimacy of transactions and their compliance with the established norms, regulations, and statutes. B. Providing evidence of stewardship. C. Assisting planning and control. D. Assisting objective and timely reporting. E. Providing the basis for decision making. F. Enhancing the appraisal of the efficiency of management. G. Highlighting the various sources of revenue, receivable, and the expenditure to be incurred. H. Identifying the sources of funding capital projects. I. Evaluating the economy, efficiency, and effectiveness with which public sector organizations pursue their goals and objectives. J. Ensuring that costs are matched by at least equivalent benefits occurring therefrom. K. Providing the details of outstanding long-term commitments and financial obligations. I. Providing the means by which actual performance may be compared with the target set. M. Preferring solutions to the various bottlenecks and/or problems identified. A further analysis of the most significant objectives of public sector accounting enumerated above is as follows. A. Determining the legitimacy of transactions and their compliance with the statutes and accepted norms. Public sector disbursements should accord with the provisions of the Appropriation Acts and financial regulations. There should be due authorization for all payments so as to avoid the commission of acts of misappropriation. B. Providing evidence of stewardship. The act of rendering stewardship is being able to account transparently and diligently for resources entrusted. Government and public sector operators are obliged to display due diligence and sense of probity in the collection and disposal of public funds. C. Assisting planning and control. The future faces a lot of risks and uncertainties. Mapping out plans prevents an organization from drifting. Plans of actions provide the focus of activities which are being pursued. The unforeseen circumstances is built into plans so as to prevent or at least reduce corporate failure. Public sector establishments should act in accordance with the mandate theory of governance. Control measures are adjunced to skillful planning. They assist in avoiding unnecessary deviations from the pursuit of the original objectives set. D. Ensuring objective and timely reporting. Users of public sector accounting information are anxious to bridge their knowledge gaps of what government is doing. They definitely treasure prompt and accurate statistics to evaluate the performance of government. E. Evaluating the costs incurred and the benefits derivable. In public sector organizations, it is difficult to measure costs and benefits in financial terms in all respects. The analysis of cost benefits assesses the economic and social advantages, benefits, and disadvantages or inconveniences, cost, of alternative courses of actions to ensure that the comfort of the citizens is well catered for. Users of public sector accounting information. The users of public sector accounting information may be discussed under the following two categories. A. Internal users. This group is made up of 1. The executive, such as the President of the Federal Republic of Nigeria, the governors of the state and chairmen of the local government councils. 2. The federal ministers and state commissioners. 3. Top administrators of government departments, e.g., the permanent secretaries and directors. 4. The chief executives of government business entities or parastatals, such as Power Holding Company of Nigeria, PSAF, and the Nigerian Ports Authority, NPA, etc. 5. Subordinates who oil the administration wheels. 6. The organized labor unions in the public service. B. External users. This group comprises 1. The National Assembly. 2. The members of the public. 3. Governments, apart from the one that is rendering the report. 4. Foreign countries. 5. Foreign financial institutions such as International Monetary Fund, IMF, World Bank, Department for International Development, DFID, United Nations Children's Fund, UNICEF, etc. 6. Creditors, both local and foreign. 7. Researchers. 8. political parties, trade unions, and civil liberty organizations. The importance of public sector accounting information to users. The internal users require accounting information in order to ascertain the various levels of regulatory compliance and whether actual expenditure is in accordance with the budget. They like to ascertain whether or not adequate safeguards are available for the protection of public resources. Conversely, the external users require accounting information to ascertain the financial viability of the public sector organizations and the efficiency and effectiveness of management. Both the internal and external users want to know whether the accounting information enhance the quality, consistency, and transparency of public sector financial reporting. The constitutional and regulatory framework of public sector accounting. Public sector accounting is governed by the following regulatory frameworks. A. Nigerian Constitution. The 1999 Constitution of the Federal Republic of Nigeria is one of the legal frameworks that regulate the receipts and the disbursements of public funds. The sectors of the Constitution quoted above authorize the receipt and payment of government, the allocation of revenue, the audit of public accounts, and other financial matters. For ease of reference, for specific sections of the 1999 Constitution and their provisions are listed below. Section 80. Establishment of the Consolidated Revenue Fund (CRF). Section 81. Authorization of expenditure from the CRF. Section 82. Authorization of expenditure in default of appropriations. Section 83. Establishment of the Contingencies Fund. Section 84. Remuneration of statutory officers. Section 84(4). Comprehensive list of statutory officers. Section 85. Audit of public accounts. Section 86. Appointment of the Auditor General for the Federation. Section 87. Tenure of office of the Auditor General for the Federation. Section 88. Power to conduct investigation by the National Assembly. Section 89. Power as to matters of evidence. Section 149. Declaration of assets and liabilities and oaths of office. Section 153. List of statutory commissions. Section 162. Establishment of the Federation accounts. Section 163. Allocation of other revenue. Section 164. Federal grant in aid of state revenue. Section 168. Provision with regard to payments. B. Audit Ordinance of 1956 or Act of 1956. Section 13, subsection 1 to 3. Mandate the Accountant General of the Federation to furnish the Auditor General for the Federation with the country's financial statements. C. Finance, Control and Management, Act of 1958, Cap 144, 1990. This governs the management and operation of government funds. It regulates the accounting system, the books of account to be kept, and the procedures to be followed in the preparation of accounts and financial statements. D. Financial regulations. These are the accounting manual of government ministries or extra-ministerial departments which deals with financial and accounting matters. They set out the procedures and steps to be followed in treating most of government transactions. According to FR 105, the Minister of Finance shall issue from time to time financial regulations which shall be in accordance with existing laws and policies of government. The financial regulations so issued shall generally apply to the Federal Public Service, which term means ministries, extra-ministerial offices, and other arms of government. E. Finance and Treasury circulars. These are administration tools which are used to amend the existing provisions of financial regulations, public service rules, and the introduction of new policy guidelines. F. Public Procurement Act 2007. This is an act which establishes the National Council on Public Procurement (NCPP) and the Bureau of Public Procurement (BPP) as the regulatory authorities responsible for the monitoring and oversight of public procurement, harmonizing the existing government policies by regulating, setting standards, and developing the legal framework and professional capacity for public procurement in Nigeria. The Act sets standards for organizing procurement, method of procurement of works, goods, consultancy and non-consultancy services, as well as the procurement approval thresholds for the Bureau of Public Procurement, tenders boards, and accounting officers for all ministries, departments, and agencies. G. Fiscal Responsibility Act 2007. This act provides for the prudent management of the nation's resources, ensures long-term macroeconomic stability of the national economy, secures greater accountability and transparency in fiscal operations within a medium-term fiscal policy framework, and the establishment of the Fiscal Responsibility Commission to ensure the promotion and enforcement of the nation's economic objectives. The Act emphasizes the preparation of medium-term expenditure framework, annual budget, budgetary execution and achievement targets, collection of public revenue, public expenditure, debt and indebtedness, borrowing, transparency and accountability. H. Other laws guiding public sector accounting and finance. Other laws guiding public sector accounting and finance include the Pension Reform Act of 2004 as amended in the Pension Reform Act of 2014, the Independent Corrupt Practices and Other Related Offences Commission (ICPC) Act of 2000, Economic and Financial Crimes Commission Establishment Act 2002, Nigerian Extractive Industries Transparency Initiative (NEITI) Act 2007, Appropriation Act, Code of Conduct Bureau and Tribunal Act 1991, and Money Laundering Act 1995. The Financial Regulations 2009 edition. The financial regulations are powerful control tools used in the public sector fund management. They are the accounting manuals of the three tiers of government designed to guide the management of public funds. The rule spells out the system concerning the receipt and disbursement of funds and the procedures to ensure good accountability, prevention, and early detection of frauds and errors and other financial malpractices. Concepts and principles applicable to public sector accounting and finance. Concepts have been defined as broad basic assumptions which underline the preparation of financial statements of an enterprise. Public sector accounting is an integral but separate branch of financial accounting, sharing in common many concepts and principles applicable in the public sector. These concepts include consistency, materiality, periodicity, duality, entity, historical cost, and going concern, etc. Basis of public sector accounting. There are three bases under which the financial statements of a public sector enterprise are compiled. These are: A. The cash basis, B. the Achra basis. C. The commitment basis. D. Modified cash basis. E. Modified Achra basis. The cash basis. It is the basis of accounting under which revenue is recorded only when cash is received, and expenditure organized only when cash is paid, irrespective of the fact that the transactions may have occurred in a previous accounting period. Non-accountants, such as general managers of government corporations and public superintendents, are often called upon to perform some accounting duties or supervise bookkeeping work. Such people need a simple method which can be operated easily. Advantages of cash basis. The advantages of this basis include the following. A. It is simple to understand. B. It eliminates the existence of debtors and creditors. C. It permits easy identification of those who authorize payments and collect revenue. D. It allows for comparison between the amount provided in the budget and that actually spent. E. It saves time and is easy to operate. F. It permits the delegation of work in certain circumstances. G. The cost of fixed assets is written off in the year of purchase, resulting in fewer accounting entries. Disadvantages of the cash basis. A. It takes unrealistic view of financial transactions, as only the resettlement of liabilities is recognized. For example, there are 4 stages through which a spending decision passes. These are: 1. Issue of order or contract from the supply of goods or services. 2. Supply of goods or services. Acknowledgement of liability. 3. Settlement of the amount of the good or service received. 4. Consumption of value. The cash basis of accounting records only stage 3, while the Achra basis takes care of stages 2, 3, and 4. The commitment basis records stages 1 to 4. B. It does not provide for depreciation since assets are written off in the year of purchase. C. It does not convey an accurate picture of the financial affairs at the end of the year. D. The cash basis cannot be used for economic decisions, as it tends to hide basic information. For example, some of the missing information relate to fixed assets, debtors, and creditors. E. It does not accord for the matching concept. Modified cash basis. Under this basis, the books of accounts are left open for a maximum of 3 months after the end of the year, so as to capture substantial amount of income or expenses relating to the year just ended. Achra basis. Under this basis, revenue is recorded when earned and expenditure acknowledged as liabilities when known, or benefits received. Notwithstanding the fact that the receipt or payment of cash have taken place wholly or partly in other accounting periods. Achra basis is practiced in the private sector and all parastatals such as Power Holding Company of Nigeria (PHCN) and Custom Services. The reason for this is that private sector concerns are profit-oriented. It is therefore necessary to estimate how much profit has been earned in each period, with a view to keeping invested assets intact and making periodic distributions to shareholders by ways of dividends. In the public sector, the main consideration is the enhancement of the standard of living of the people. Advantages of Achra basis. The advantages of this basis can be summarized as follows. A. It takes a realistic view of financial transactions. It reviews an accurate picture of the state of financial affairs at the end of the period. C. It could be used for both economic and investment decision making, as all parameters for performance appraisal are available. D. It aligns with the matching concept. A. It makes allowances for the diminution in the value of assets used to generate the revenue of the enterprise. Disadvantage of Achra basis. A. It is very difficult to understand, especially by non-accountants. B. It does not permit easy delegation of work in certain circumstances. Modified Achra basis. This is the basis under which revenue is recorded when received and not earned, while expenditure is recorded once its liability is incurred. It means the cash basis is used for recording revenue, while Achra basis is adopted for expenditure. The modified Achra basis operates as follows. Revenue is recorded when cash is received, except for A. Revenue which is susceptible to Achra, and B. Revenue of a material amount which has not been received at the normal time it should. Expenditure is recorded on Achra basis except in the cases of A. Disbursements for inventory items which may be considered as expenditure at the time the items are utilized. B. Interest on long-term debt commonly accounted for in debt service funds and recorded as expenditure on its due date. Commitment basis. It is a basis that records anticipated expenditure evidenced by a contract or a purchase order. In public sector financing, budgetary and accounting systems are closely related to the commitment basis. Advantages of commitment basis. Commitment accounts keep on a memorandum basis have several advantages. These include A. A separate payment tabulation is available when required. B. Adjustment occurring when actual expenditure has been obtained does not affect the final accounts. C. It is an aid to financial control. A commitment is regarded as a charge which has been made on a budget provision. D. It takes a realistic view of financial transactions. E. It reviews an accurate picture of the state of financial affairs at the end of the period. F. It is used for both economic and investment decision making, as all parameters for performance appraisals are available. G. It aligns with the matching concept. H. It makes allowance for the diminution in the value of assets employed to generate the revenue of the enterprise. Disadvantages of commitment basis. The system of commitment basis of accounting has the following disadvantages. A. The system involves extra work. Actual figures have to be substituted for the commitment provisions to finally determine the running balances under the subheads of expenditure. B. Over-expenditure is more under commitment basis in the expectation that government may finally release funds to settle the legal obligations. C. At the year end, all commitments that are the subject of unfulfilled orders will have to be written back to reflect the exact picture of the transactions which took place during the year. D. Balances which ought to have lapsed in the vote book at the end of the year may be spent by issuing local purchase orders to exhaust the votes. Comparison between government accounting and private sector accounting. A. The main objective of a financial enterprise is to maximize profit, while that of government is to provide adequate welfare to the people at reasonable cost. B. Government revenue is derived from the public in the form of taxation, fines, fees, etc., whereas business concerns obtain their income principally from the sales of goods and services. C. In government, financial transactions are recorded on cash basis, while in commercial organizations it is on Achra basis. D. In public sector accounting, tangible fixed assets such as land and building, plant and machinery are not shown in the balance sheet, whereas in private sector accounting these are reflected, showing the historical cost, accumulated depreciation, and the net book value of each. In public sector accounting, current assets such as stocks and debtors are not shown in the balance sheet. Debtors and creditors are not reckoned with until money is received or paid. The current assets and the current liabilities are shown in private sector accounting system. In government, there is no annual general meeting of stakeholders or shareholders unlike the situation with commercial enterprises. What government does is to hold public briefing on specific issues. G. In public sector accounting, what operates substantially is fund accounting. However, in private sector accounting, the proprietary approach is adopted. H. Public sector accounting thrives rigidly on the budgetary approach, whereas in private sector accounting, budgeting is embraced as a very potent control instrument. Chapter review. This chapter discusses the introductory aspects of public sector accounting and finance, with emphasis on the objectives, users of accounting information, constitutional and regulatory framework, as well as concepts, principles, and basis of accounting.